Welcome to PM Express Business Edition. Its fall or reduction in value has been described by many as unprecedented. What is actually causing the challenge and how can we address it? Well, I'm talking about the depreciation of the Ghana Cedi over the first 2 months. Is said to have gone down or dropped in value by more than 6%. What are we not doing right in these times, from the economic angle and the monetary as well, to halt this fast rate of depreciation of the Ghana Cedi? Is it a fiscal issue or a monetary issue, or it can be described as an external challenge that every country or economy is exposed to? Well, helping address the fast depreciation of the Ghana Cedi with the economists, the businessmen, and those who play in the industry. All these issues wrapped up on PM Express Business Edition. We'll be right back after this break. Welcome back to PM Express Business Edition, and it's been the talk of town because of how it is impacting on the operations of businesses, the economy, and even you and I. It's about the depreciation of the Ghana Cedi and the larger economy. Today on PM Express, we'll be engaging an economist. Professor Babuati is an economist and the head of the Economics Department at University of Ghana Business School. Dr. Sam Ankra is the president of the African Investment Group, and Dr. Humphrey Dake is president of AGI. So, industry, private sector, the economist, and the academia. How do we address the perennial fall of the Ghana Cedi in every first quarter? But it looks like things have gotten out of hand this time round. Let me connect via Zoom and speak to the economist as we look at the bigger or the larger economy first with the Professor William Babuati. And Prof, thank you so much for your time, for connecting with us via Zoom. And for you as an economist, I mean, what do you make of what is happening right now with the Ghana Cedi?
Well, thank you very much. And before I start, maybe let me make this correction. So I am in the Department of Economics, University of Ghana, but not University of Ghana Business School.
Yeah, sorry.
So Department of Economics is in the School of Social Sciences, College of Humanities. So let me, I know my colleagues at business school will laugh, but that is the truth. We are not part of business school.
Okay.
We are part of School of Social Sciences. So let me start by saying that this has become more like a cycle. And at the end of every election, that is a year or two, we go through this. And the point is that when Ghana became a middle income country from 2010, Ghana should have realized that we couldn't have done business as usual. When we were below the middle income level, we were getting some support from donor agencies, the World Bank, the IMF, and other multinationals. But we expect that as soon as we became of age, that means that we became a middle income country. It means that we have to take our own destiny into our own hands and get to the Euro market to be able to get, to be able to borrow on commercial basis. And the moment you go to the Euro market and to deal with some of these things on commercial basis, then your economic management should be in such a way that whatever investment you make out of what you borrow is supposed to generate sufficient returns to be able to pay back in foreign currency and in also domestic currency. But that is what we have failed to do. I mean, from 2010, it appears that all government put a lot of premium on social intervention, which is not bad in itself, but we have to make sure that we needed revenue to be able to pay back. But unfortunately, whilst we are doing all this, we don't pay much attention to our revenue generation. When I say revenue generation, I'm not saying that we are not paying the needed taxes. We are paying, but as to whether we are able to block the leakages and it is not leaking out, is another thing altogether. So whilst you are a middle income country and you are going out there to borrow, you need to invest and get the returns through taxes And if they are not coming and you begin to have fiscal deficit, and as I say, the fiscal arm of economic management is the midfield. It is the engine room of economic management. The moment you get it in a shaky kind of situation, then it transcends into other areas of economic management. And that is why we have this exchange rate depreciating so fast on our hands. And the funny thing is that the moment the Cedi begins to depreciate and you are not able to tame it, then speculation sets in. It means that you will be chasing it, and if you don't take care, it will be very difficult to stop it. And that is the situation that we find ourselves.
Prof, I know way back in the lecture halls and all the rest, we were told that, we have to export more to get more earnings to back our currency and all the rest. And this has been perennial. I stand to be educated since I grew up. Why are we not having a way to still continue? Every currency depreciates around the world. I mean that for a fact. But why haven't you been able to find some innovative ways to deal with this? I think that we are importing more than exporting, if I'm right. And what you guys taught us way back in school, Prof.
Well, I think it's funny. It's funny when we begin to look at just one side of the problem. And since I was a student in secondary school from 1984 coming to sixth form in 1989 to 1991, we had increasing export and reducing imports and so on. And I think we need to look at the current situation and not go to the textbook and continue to quote. But the situation that we are finding ourselves is not linked to export and imports.
No.
I mean, in recent...
That is interesting, Prof. I mean, you think that it's not an issue about exporting more to generate more foreign currencies?
I think I went off a bit. Yes, but so we look at the balance of payment. I think we've had some positive trade balance, not as much as we expect. And then, of course, we also have the current account, which is not doing badly. But when you go to the capital account, that is where the problem is. Because having gone to the euro market to borrow, it will get to a time where the debt will mature and you need to pay back. So paying back, if you're not able to generate enough foreign exchange and also revenue, then you are going to have a challenge in paying back. I can tell you, if Ghana had not been rated downwards, the rating agencies have rated us downwards, and that has made us put us in a situation where we cannot borrow at a competitive rate. So if we had not gone there, perhaps the situation that we find ourselves, we could have gone to the euro market to borrow to be able to tame the exchange rate. But here we are. Unfortunately, we cannot go, and if we have to go, it will be at a very high rate. And that is the challenge that we find ourselves currently. So it is not, as we say, export and import per se, but we need to look at the capital market. When you want to look at export as the way to solve our exchange rate problem, it is a long-term kind of solution prescribing, because there is export elasticity. I mean, if we want to increase our export of cocoa, it doesn't take a day or two. It takes years, 1 year, 2 years, 3 years, 4 years. If you want to even use oil, it takes years. So when we talk about exports, then we are just looking at long term. At the situation we find ourselves, we need to look at the short term, the medium term, before we even think about long term. So the capital market is where the challenge is. And one thing that we should bear in mind is that when the Minister of Finance read the budget in November, if you look at the noise that has gone on, especially with revenue generation and the e-levy and so on and so forth. I mean, investors look at what is happening on the market, and just by clicking the button, they can move their money from one point to the other, and it is swift. So investors don't know what is ahead of them. There is some kind of uncertainty. Therefore, they are withdrawing. Those who haven't gotten to the maturity stage, they are discounting them. And those who have gotten, they are not willing to even extend it. And that is where the challenge is. Another challenge that we have not been able to put our hands on is allowing multinationals who are here to repatriate their profit freely and they repatriate this profit in dollars, and it puts a lot of pressure on our local currency. And I think this is where we also need to look at, to be able to look at the short-term way of taking the Cedi before we talk about the long term about the export and import.
And Prof, let me bring in some private sector persons as well. Dr. Samankra, he's the president of the African Group. He's an exporter, he's an investment person. Also be joining us also is Dr. Humphrey Daka, he's president of AGI, to bring in the perspective of these private sector persons about how bad is the situation and how can we get around it. Dr. Samankra is the president of the African Investment Group. He is an investment person and also in the commodity trade business. Doc, thank you so much for joining us. And for you, Doc, as a private sector person, how bad is the situation affecting you?
George, I could barely hear you. As you know, I've just parked to the side of the road to speak to you. But then just, if you can hear me, I think it's about time that we redefine our economic models and create systems that speak to our African experience. How am I saying this? What is the main purpose of money? First is a unit of value, is a store of value, and is a medium of exchange. In our country here, Ghana, because we import virtually everything, the first two properties, that is the unit of value and the store of value, is really in reference to the USD. Our CDs is merely a medium of exchange. So I propose, and again, it's going to be a very difficult policy direction, but I think in order to create stability and curb inflation, if we were to do with the CD, everyone will be better off. All the CDs does now is to allow the country to misuse central bank's privileges. We're nowhere near balancing our trade. So we should stop pretending and move to the dollar. Or do the needful and block imports and protect local goods and services. We can still use the city anyway, but then the central bank has to set the rate 1-to-1 with the dollar.
But Doc, let me come in there, and I hope you can hear me. I mean, okay, for such a developing economy, some have said, and I know you are an economist as well, about us shying away from a regulated or fixing exchange rate, rather to allow the forces of demand and supply to dictate the pricing of these things. Aren't we getting into a fixed exchange rate regime which we need to get out of?
Well, I mean, George, we have a deficit. We're importing everything. Are you understanding me? So if the best way for us to solve this problem, as I proposed earlier, is to get a central bank to fix the rate or set the rate as 1-to-1. Not just the rebate, but set it there so that they don't have to float freely or near freely. Because we are back to the balance of trade, and we're in deficit. We are a net importer. So our local currency will continue to devalue. So what I'm saying is we should find a permanent solution, a perpetual solution to the perpetual loss of the value of the city.
And you think that fixing the rates could be an interim solution now? Having a fixed exchange rate regime right now can address that problem?
Absolutely. I mean, that's the only way, because look, we keep importing. We're importing even toothpicks. Everything is you're importing, and we've dollarized our economy. So we might as well be honest about it. And all the other alternative is to cut imports totally, as other countries did some years ago, the likes of Norway and co. Block every import and practice local manufactured products. If that's the way to go, that can help. But with this to and fro, where government has been pumping USD into the systems to make the forex rate stable, this it's good for business, but it's artificial and it's unsustainable. So when the forex stops, as it is now, inflation, we get back to inflation. So the sustainability of the solutions that we're using hasn't been working. So we need to look at options, or else we keep on going merry-go-round, having the same problems every day. You go and bring dollars, you come and pop into the system, it creates inflation, and then when there's no dollars, the demand and supply issue arises, and there's a high demand for dollar, and then it keeps going up. So we're just throwing ourselves on a yo-yo. There has to be a permanent solution, George, to this problem.
You to also get your perspective of how bad the situation is for you and how you're managing it. Let me get the thoughts of industries as well, those who are in the manufacturing sector, those who they are supposed to actually help export more to deal with this problem. Dr. Humphrey Daka is president of AGI. And Doc, I appreciate your time so much. So for you as manufacturers, how is this thing hitting you? Dr. Humphrey Daka, if you can hear me, I was just trying to get your thoughts.
Well, thank you, George, and say hi to... Can you hear me?
I can hear you, Doc. Please, you can go ahead.
Hello, Doc.
I can hear you.
Hello, George.
I can hear you.
Okay, thank you. And so say hi to the panelists. Well, to us, these are difficult times. It's obvious that a number of these difficulties are cyclical. Every first quarter of the year, we see this emerging pattern. The biggest concern is how to crack and change the status quo that has been happening year on year over the last decade plus. So to industry, once the depreciation sets in, automatically it hits our cost line, bottom line, and therefore cost of operations thereby have an effect by virtue of the extent of import that every entity does. And I believe that every entity, to a large extent in the manufacturing space, imports one input or the other. And therefore the effect of the exchange rate cannot be eluding any of the manufacturing enterprises. Unfortunately, depending on the degree of impact, the entity then decides to transfer in terms of pricing to the product that goes to the market. However, if you have signed in terms of contracts that are binding, you have no other choice than to grapple with your cost of operation, because the contracts might have a binding rate, and if it's unfortunate that it's not in dollars or any foreign currency and it's in the local currency, then it hits the individual enterprises very hard. So going forward, one would ask the question, how do we mitigate these situations in our operations? As much as possible, we try to cut down costs on the non-core areas, try to stay in business. If your contract is that close and tight, you need to figure out how to sustain yourself. If you had made provisions in terms of margins that could cushion this. If not, you need to go back to your parties in terms of the contractual arrangement to renegotiate. When you do not have that choice, then you need to pass on the price on the final product to the final consumer. It's so significant that in this particular era, one will say the rating agency's opinion on the economy, one that is on the debt position of the sovereign debt, and furthermore on the banks that are buying the various debts or various bonds and instruments of government, had a hit. And therefore the opinion on both of the organization, i.e. government and the banks, became a deterrent to most investors. And you are aware that when it happens like that, interest rate differentials that the trading community in forex and in instruments then become very volatile, and therefore it becomes a driver for the forex to behave as it is. We are not surprised that the opinion of the rating agencies are having impact.
Mr. Dake, if you can hear me, Mr. Dake, I just want to make a quick point. If you can hear me, Mr. Dake, just a quick one. So you are in the manufacturing sector. How is this impacting you? You are talking about pricing here. Are you going to absorb the shocks or you're going to pass it on to us?
If you can hear, it will depend on each entity. Like I mentioned, if the enterprise, yeah, can you hear me?
I can hear you.
Hello, George?
I can hear you.
Okay, so it depends on each sector of the economy, and secondly, on the entity. Yes, I'm speaking on the matter. So I'm suggesting that it depends on each enterprise, and secondly, which sector you belong to. Given that you have contracts that are very close in nature, where your prices have been determined in the contract, it becomes very difficult to pass it on. So you might need to cut down on cost, some might sacrifice quality, and then on the other flip side, where you have no choice, that you can pass it on to the customer, you go into negotiate. And then thirdly, when your products are traded on the market, you are forced to pass on the price onto the product that ends up with the consumer.
So we should expect some possible price hikes, if I'm right, because of this challenge.
It might not be blanket throughout,
but some sectors and some goods
throughout. Definitely some sectors, some goods, like it's happening with the transport companies combining the fuel hikes and exchange rate hikes. They will come to the table and agitate for increment. So, but some product may escape it. The producers will absorb it because of the market space or market share they control, and use mass production to mitigate the situation. However, where you do not find yourself in that advantageous position, you have no choice but to do some reasonable price increase to survive the tides.
Hold on, Mr. Humphrey. I'll get back to you again as in solutions in the way for. Let me bring in the economist, Professor William Barbwatting. He's the head of the Econs Department, the University of Ghana, Prof. And thank you so much. This time I got it right. And for you, sitting back as an economist, what are those tough measures that can be taken now to halt the free fall of the Ghana cedi? Is it a fiscal problem? Is it a monetary thing, or what?
Well, as I said, the fiscal is the engine room of economic management. And the moment you have revenue shortfalls and then expenditure remains as it is and nothing is being done, you have this fiscal deficit, and it then translates into debt. Then your public debt goes up and so on. So I look at it from this way. I think it's to start from the fiscal part of it. Maybe somebody will say, well, the central bank needs to intervene. But how long can the central bank intervene? Will the central bank intervene and just deplete our reserves? That is an option that we may not want to go there. So I think it should start from the fiscal side. So if you look at our current expenditure components, we have our compensation, which takes about 56%. And then we also have our, the debt service, which is quite high, and then earmark funds. Now, in that case, if you have about 144% of your tax revenue into these three areas, then how do you go about it? I think the first thing to be done is government trying to demonstrate that they are committed. They know that there are challenges, and therefore government is committed to bring down the expenditure on their side. I am expecting a statement like from the president or from Minister of Finance, trying to tell all ministries, whether ministers or civil servants, not to buy any new vehicle for any office holder. When you do that, it means you are doing two things. One, you are trying to reduce your expenditure, and two, the importation of these vehicles will also send signals to the public that you are committed to doing this. Then there are other things that government will need to look at, very tough measures. I mean, social intervention that government rolled out since 2017 are very good. And I think it is high time government rethink about some of these social interventions and reserve some kind of money and reduce the pressure on the fiscal arm of economic management. And maybe it is difficult to mention free senior high. I think government need to review that and then maybe go the way that that used to be in terms of providing bursaries or support for the needy, while those who can afford will continue to pay. And in that case, government will be able to free out some resources for other areas. I'm sure some of them you may not consider them to be popular, but I think it is important we need to take that.
But Prof, just let me cut in a little bit. I mean, in all these donor programs that we've entered into, one of the big concerns has to do with how do we safeguard these social intervention programs. Now, in terms of the short to medium term, how would the cut?
Well, I'm just getting.
Okay, fine. Go ahead. Sorry.
Yeah. So I'm just going step by step. And as I said, I started by saying the fiscal arm of economic management, it's the engine room. And the moment you are able to get hold of the fiscal part, then you can, it will trickle down to the other part of it. So if investors begin to see that government is committed to reducing its expenditure, and then government is committed to increasing its revenue, then they know that, well, even if we have our money with this government, we know that they can pay in future and they will not rush to withdraw them. So I was talking about trying to look at some of these social intervention, review them, and then reduce the amount of money you spend on them so that those who can afford will also be able to pay and help the government. I'm sure it will be an unpopular decision in terms of politics, but I think from economic perspective, it will not be bad. I mean, everybody is talking about paying teacher training allowances, paying nurse training allowances. I mean, this is where teachers, College of Education are now tertiary, and then you are paying them allowances, whilst university and other tertiary institutions are not. Why don't we review that kind of policy and make them come on board on the loans? So in bits, you will be able to reduce the pressure on, from expenditure side, and while government tries to put measures in place to be able to up the revenue and be able to close the gap, it sends a very good signal to investors that government is committed to cleaning up the as it were, the difficulties that government has in the fiscal space. And if the fiscal space is doing very well, then we expect that it will trickle down to the exchange rate and other parts of economic management.
So I get from you, it's more of a fiscal. The finance minister previously announced some 20% cut in quarterly expenditure estimates, wrapping up to about 12 billion Ghana cedis. You think that is still not enough?
Well, I think he can do more. I'm sure. That is a very bold decision, and I commend the finance minister for doing that. I think we need to do more. The other side of it is the revenue, and I've made that point elsewhere. I think in economics we say money doesn't like noise, and I think we have used the e-levy to make a lot of noise, and investors don't even know what is ahead of them. I think when a policy is coming and you debate the policy for a month or two, I think a decision needs to be arrived at, and then we know our way clear. I would say that I think that it's time for us to end the debate and then begin the implementation. I have my own position as far as the e-levy is concerned, but we cannot continue to use the whole year to debate as to whether it is good or bad. Why don't we support government for government to pass it and then see how the market will respond? And then if the market responds and then the outcome is negative, I'm sure government will come back and review it. But if the market responds and then the outcome becomes positive, then we are able to solve our revenue and then close the gap and then give a very good signal to investors. I don't want to go to the monetary part because we cannot afford to deplete our reserves. Maybe the other side that I will talk about as far as the monetary policy is concerned is that maybe the central bank can weigh the two and then look at whether they can up the interest rate so that it will balance the equation. Because if you up the domestic interest rate, then it will also get some investors to think about the returns they are going to get, and then it will also reduce the pressure from the drawings as we have. So when we have exchange rate misbehaving, then you cannot intervene. I think the other option that maybe the central bank can do is to look at the interest rate. If the policy rate is raised a bit up, I think it will have some kind of ripple effect, especially the treasury bill rate, and then we'll be able to get money that are in the hands of people and putting pressure on the few cities. Then you can get them into the bank, and then it will reduce the pressure on the
Prof, I'll be coming back to you about the dollarization of the economy and how can that also help when you look at the macro angle and the macro picture. Let me get back to Dr. Samankra. He's an investor. He's into commodity trading as well, and also the finance space as well. And you engage these investors a lot across the continent. What do they want now when it comes to the challenge with the Ghana cedi, Dr. Ankara?
Okay. George, I mean, let me make a very important statement here. The issue is not the exchange rate. It's the continuous slippage of the rate. Okay? Let's say, for example, you take 30 million to buy diesel. You retail it in cedi and collect your cedi. By the time you go searching for dollars, you realize that you've raised only 28 million. You've lost 2 million. Just based on the inflation. So the attractiveness of the export due to the ability to leverage more cedis to the dollar is one thing. The stability or store of value, that's the significance of the Ghanaian cedis user, is quite another thing. So we got to look at it very carefully. The volatility is too high. So that is why when I spoke earlier, I proposed that they have to peg the cedi, because if we're going to continue to import everything and we have this balance of trade deficit, we can't just have a cosmetic solution. There has to be a fundamental solution once and for all, because as all the speakers have explained, it looks like every year we're going to have this challenge. How long are we going to continue going back and forth as a nation? So we either take a policy stand to cut imports completely and send homegrown products, or we peg the dollar to the cedi, command the central bank to do so. So we know exactly where we are, or else we're going to have these challenges coming on, and it's going to get worse and worse and worse. And investors are worried.
And Sam, I was trying to get this thought because of the space you play in and how you engage most of these investors across the continent. One, I get from you that the volatility, they don't like it, and that is pushing them away. On the fiscal side, as has been spoken about earlier on, what do they want from government to send them that signal that, listen, government mean business, so now we'll hold on to, we're not selling our bonds and all the rest, we'll do business with Ghana, we're not going to rush out?
Well, I mean, it's not a policy that just has to benefit investors. It's a policy that has to benefit the locals as well, local investors as well. So government just has to, they don't have to do a rebate that was done before and then you allow it to go on a free fall. No, you peg the cedi against the dollar 1-to-1. And that's what the central bank has to do. And once they do that, then at least the issue of inflation or the volatility of taking 30 million, going to buy products, selling in cedis, and by the time you purchase the dollar, you are less off, would be over. And these are the things that could be passed on to the consumer. If we don't do that, and we keep going on doing the cosmetic solutions, and every year government would take dollars and pump into the market, and when they don't have the dollar, the demand will go high and the rate will go up. I don't think that is planning. I don't think that is prudent. Let's find a lasting solution. Let's sit down collectively and decide on what we want to do as a nation. What policy direction are we taking? Are we going on imports? Then if we go on imports, this is a process that we have to take. Are we going to stay on local manufactured products? This is how we have to go. If we don't have a clear, defined economic model or policy, and we keep going back and forth as a nation, we will be having these challenges, and I can guarantee you, next year, come around the same period, you and I will be on this phone having the same discussion.
Interesting. Right, next year around this time, we're talking about the same thing. Dr. Humphrey, DACA, AGI, I mean, what has happened to the 1D, 1F, and all those programs that were supposed to help us export a lot also to build up our reserves? What is happening in the manufacturing sector? Dr. Humphrey,
yeah, I can hear you.
I was just asking.
So that was the intention for the structural transformation of the economy. Yeah, I'm saying that was the strategy for the structural transformation of the economy. And there are challenges like the famous, what we call the benchmark values crisis that we have been engaging, and it's taking government a long time to make significant decision in that space. However, I wish to comment on a couple of issues between that of Dr. Sam and that of the economist.
Professor
I'm of
the
opinion that government should demonstrate commitment to austerity measure. Can you hear me?
I can hear you.
Can you hear me?
Yes, sir.
Hello, George.
Yes, I can hear you.
Okay. So I'm suggesting that government should demonstrate commitment to austerity measures as indicated by the expenditure cut by 20%, to show further commitment to value for money projects, to also prioritize its projects and do effective monitoring, to demonstrate to the investors and the larger Ghanaian community its intention to down on its expenditure. However, once that is done, government then could then explore further the new revenue measures. Because you see, once the investors look at the speculative nature of your new revenue streams, that will augment your fiscals, and we're going through a lot of banter to accept new revenue streams to correct the gaps, and that is a challenge. And we also have related matters like the benchmark values that goes directly to the macroeconomic and then the economic structure or the economic formula that the country depends on, where food basket are being shortchanged by virtue of rebates. The AGA have said that the benchmark values has created a rebate for imports. Then it worsens the plight and the cyclical issue. So our position is that once government demonstrates significant commitment to austerity and then also indicates clearly how best the new revenue measures will be spent to correct the wrongs, you bring confidence back into the economy. And then our friend the economist mentioned the macroeconomic policies and how the BOG should react. And we of course, with this dynamics, one will expect that in the next MPC report, it's most likely that the policy rate may be jacked up to control this depreciation phenomenon, and also the inflationary ones that are also coming as a result of non-food basket, like the fuel-related ones, and that of the basket of food as well. But going to the short to medium-term approach, we in the AGA have stated that through the BOG, Bank of Ghana, and its monetary policy report, we should target specific interventions to the food basket. Yes, government made a significant effort through a number of initiatives through the Ministry of Agri, i.e. the Planting for Food and Jobs, the warehousing, fertilizer projects, and many more. However, with the intervention of benchmark values, discount value, you reverse all the gains. The
Okay.
aggregate of those reversals and its impact beyond 2019-2020, we are facing all this currently. So the macro policy strategies should be relooked at, and the benchmark value, we believe, goes directly to the macro stage because it determines the inflation through the consumer price index being built from the producer price index.
Okay.
Those are the related ones we expect government to intervene on.
Let me bring in Professor Bob Whiting, an economist again. And some have argued that, listen, the
Hello,
best...
George.
Yeah, I'm bringing in Professor Bob Whiting, Neve, Professor Bob Whiting, the economist. And Prof, some will say that the best way to deal with this challenge is about stabilizing and having a strong currency. Dollarization is not going to help. Today, you won't pass any place without prices being quoted in dollars. How do we make our local currency strong and deal with this practice where everyone is now switching to dollars for everything? Because if my fees are being paid in dollars, I will demand dollars to store and pay that fees.
Well, it's a cyclical kind of situation that for the moment you begin to have the cedi depreciate so fast against the dollar, that the confidence that the public has with the cedi, that then wins, and then everybody will want to quote whatever he has in dollars. So first you need to have a way to stabilize it, and when you stabilize it, then you will be able to get people to have confidence in the cedi, and then people will not be able to quote the prices in dollars. So to be able to stabilize the cedi, I think we've said a lot about the fiscal side, the monetary side. So for the short term, what we have explained should be something that the government.
But Prof, sorry to cut in. I was just talking about enforcing the foreign exchange laws that actually bars these quotation in dollar, because the laws are there. What is stopping Bank of Ghana and the relevant agencies to stop? Even for some government agencies at the ports, they are quoting in dollars.
Yeah. So I was coming there. The moment you have the cedi depreciate so fast, no matter how whatever measures you put in place to enforce it, people will still find a way. They will still quote it in dollars in their mind, but they will tell you it's in cedis. So the first thing is to try and stabilize the cedi, get people to have confidence in it. Then you begin to put measures in place to be able to stop people from quoting stuff in dollars. But unfortunately in Ghana, and I think we've said this in the past, it's only in Ghana that you can just walk and change dollars without showing your identity. In many countries in Africa, even though you can buy dollar or convert your local currency into dollars, you need to identify yourself with your ID card, with your passport, so that the central bank will be able to know how many dollars are being exchanged and so on. But in Ghana, when you walk into a forex bureau, you can only just give your dollar and then get your cedis, and nobody questions anything. So the dollar that you are giving to the forex bureau, it can go to the black market. So whilst we're trying to put measures in place to ensure that we have confidence in the cedi, the enforcement should come with anybody who is trading in dollars or in foreign currency should be able to do so by identifying yourself. Now that we have our ID card, I think it is important that we'll be able to put your ID card there, your number, and then the central bank will be able to know how the dollars and cedis are going around. But you will be able to tell people not to quote it in dollars, not to write it not to write their prices in dollars. You can tell them not to do so, but implicitly they will still be trading their goods in dollars, but then they will quote it in cedis. So the first thing is to have to get confidence back, and then people will then be able to know, well, we can quote this in cedis, and then you bring other measures as well.
Dr. Samankra, in a minute, your final thoughts as we try and wrap up on the show. Your final thoughts, Dr. Samankra, in a minute.
Point to what you discussed at first, but let me just go straight. I would say consider dollarization for a period. Start banning import, chicken, rice, tomatoes, sugar, all these things. You should start banning them. And we should up the balance of trade deficit and reduce the need for dollars. We should focus on export. Benchmark revenues should be high. The government shouldn't be backing away from this. Having it last year was not the right idea. It was a wrong move. We should reduce export costs and encourage export and other costs at the port. We should make the cost of doing business exporting as cheap as possible and hassle-free. These are real policies that need to be implemented to get solutions. George, if we're not doing this, we should just forget about trying to solve it because everything else is cosmetic.
Thank you so much, Dr. Amfridake AGR. Your final thoughts in a minute.
Two things I'll propose. Exporting of industrial raw materials outside Ghana should be hiked in terms of tariff to deter people from exporting raw materials. You could then reverse it and put it on finished product, and therefore to promote export of finished product. Secondly, the speculative nature and talking down on our currency in the media should be managed.
Okay.
And thirdly,
okay.
I'm of the opinion that finally.
Let me bring in Professor Bob Whiting in 30 seconds. Your final thoughts.
That in trying to manage the cedi, we have to control and manage our fiscal arm of economic management very well, and then it will trickle down to the other parts of the economy. And for the monetary side, I expect the Monetary Policy Committee to take a second look at the policy rate, see how best we can use it to balance the equation and reduce and tame the inflation of the cedi a bit.
So it's all about confidence building, and that might do the trick. I know the debates will still continue in the offices about how best we can tame this because of its impact on the larger economy. It's been PM Express Business Edition to talk about the cedi and the economy. Have a great day.